students, today we are going to start a new chapter, that is depreciation. Depreciation is a very important chapter and the concept should be very clear because you are going to study in class 11, again in class 12 and then again in CA foundation also. So try to follow me throughout the video. I'll try to make it as easy as possible. So first of all, let us start with what do you mean by depreciation? What do you understand by depreciation? So it is basically a reduction in the cost of asset due to wear and tear, due to efflux of time, due to accidents, due to various reasons. So what is meant by that? Like suppose you purchase an asset into a business and it has some useful life. After a few years that asset might become obsolete. So during those years, what happens is that its value keeps on reducing. That is due to usage, due to wear and tear, or might be because of some accidents or some other reasons also. So this reduction in the value is known as depreciation, which we charge every year so as to show the actual a realistic value of the asset. So depreciation is referred to as the reduction in the cost of fixed asset in a sequential order due to wear and tear till the asset becomes obsolete. So it is a process of allocating the cost of tangible fixed asset over its useful life. Okay, with an example, if a company purchases a machinery for 1 lakh and expects it to last over 5 years, that means over the 5 years this machinery will get reduced. So we have to charge this depreciation equally over the 5 years. Now the causes of depreciation. I told you wear and tear. That means physical usage of asset leads to wear and tear, decreasing its value. Suppose you purchase a new asset, a new refrigerator or new car, and after you keep on using it, after say 5 to 6 years, this car will not have the same value as it was when you purchased it. The second cause is obsolescence. Obsolescence means technological advancement. This leads to what? If due to technology advancement, if some better machine comes or better technology comes, so we will definitely switch to that. Like TV. Previously it was LED TV or SA TV and then now it has a smart TV has come up. So we would prefer to have our previous TV. We'll like to scrap it off and purchase a smart TV instead. So this is obsolescence. Then efflux of time is passage of time itself can reduce the value of certain asset. So assets cease to exist on expiry of their life. Then accident or damage. This also leads to reduction in the value of asset. So these are the 4 basic causes due to which depreciation occurs. Now what are the features? That is, depreciation will reduce the book value. And it is a continuous process. The wear and tear continuously keeps on happening every year. It is a non-cash expense because no cash is involved and it is an expired cost. What do you mean by this? That is, it is used up over a time. This asset, this loses its value. And the last one is, it is not a process of valuation of fixed asset, but actually it is accounting of expenses because we treat depreciation as an expense. So what are the methods of depreciation? There are basically 3 methods, which is straight line method, written down value method and unit of production method. So straight line method is the simplest one, which is when depreciation is calculated at a fixed cost. Every year the same depreciation will be charged on the assets. And written down value method, it is based on the assets book value at the start of the year. So every year depreciation will be calculated at a rate on the written down value, that is value at the end of that year. I'll explain to you later on when we do the practical sums. And unit of production method, it is linked to the assets usage or output. This is used in typical type of assets like natural assets, resources or oil mines and all. In that case, when these oil mines, the extraction keeps on happening, then the use of production method is used. Okay, now there are three terms which are almost similar to each other, and but a little bit of difference is there. So let us study that. Depreciation, which we studied, refers to a gradual reduction in the value of tangible fixed asset. So what is tangible fixed asset? Which we can touch, which is physically we can see, like machinery, buildings, vehicles, etc. This happens due to wear and tear, obsolescence or aging. So here the allocation of the fixed asset or the cost of the fixed assets over useful life is done in a systematic manner. What is now amortization? Amortization is also similar to depreciation, but the only difference is that it is the writing of the cost of the intangible asset. So what are the intangible assets? They are patents, goodwill, trademarks, which you cannot see, but they are of some value in the business. Now depletion. Depletion is the process of allocating the cost of natural resources like oil, gas, minerals or timber over time as the resources are extracted and used. So natural resources like oil reserves or coal mines, timber, etc., they are consumed or extracted, and in this way their value gets reduced. So this is called depletion. Now, what are the objectives of depreciation? First, ascertaining the true profit and loss. The true profit of the enterprise can be ascertained when all the costs incurred for the purpose of earning has been debited to profit and loss account. So depreciation being an expense must be debited to profit and loss account. Okay. So without calculating, because there is no cash involved, so often people try to ignore it. But if you ignore, you will not be able to find out the actual true value of the asset in your balance sheet, and year by year the expense that is actually happening, that also you won't be able to charge. So this is depreciation is done so that the expenses is debited to the profit and loss account. Second is presentation of true and fair value of the asset. If depreciation is not provided, then value of asset shown in the balance sheet will not be the true and fair value of the asset, because they are shown at cost price and no reduction is made. Third is to ascertain the accurate cost of production. So depreciation is an item of expense and the correct cost of production cannot be calculated unless it is taken into consideration. That means your profit will always be inflated if you don't consider depreciation as an expense. Then fourth is also an important thing, computation of the correct income tax. Income tax of an enterprise is determined after charging all the cost of production. If depreciation is not charged, then profits will be higher and always you will be paying a higher income tax. So depreciation is charged and tax liability is calculated accordingly. And fifth is provision of funds and replacement of asset. So depreciation is a non-cash expenses. So if you keep on charging this depreciation to profit and loss account every year, then some amount of money will be retained so that this can be used later on for replacement of assets, etc. So the types of depreciation method. Let us now discuss about the three methods actually. The straight line method, that is called the SLM method, the written down value method, that is the WDV method, and unit of production method. So first start with SLM method. So this is a method where depreciation is charged equally every year. So this is also known as original cost method or fixed installment method or equal installment method. That is, under this method, the depreciation is charged at a fixed percentage of the original cost throughout its estimated life. The formula will be the original cost minus the estimated scrap value divided by the estimated life in years. So an example to explain this, a firm purchases a machinery for rupees 2,25,000. The expected life of this machinery is 5 years, and after 5 years the scrap of this machine will be realized at 25,000. So how to calculate this? Putting the formula, Like 2,25,000 original cost minus 25,000 divided by number of years, that is 5. That comes to 40,000. So 40,000 depreciation will be charged every year. Now the advantages of it. First is ease of calculation. Every year the same amount of depreciation once you calculate, and every year that will be deducted. Then consistency, that is the amount of depreciation remains the same, making it easier to compare the organization's profit. Then it is suitable for small businesses, because small businesses, they have small assets, like assets are not so expensive and they get used up easily. So this method is very helpful for these small businesses. Now coming to WDV method. So WDV method is a different method. Depreciation is calculated on the book value of the asset each year. So each year the book value is calculated as original cost minus the depreciation for the year. So the rate of depreciation is fixed, and this rate is applied to this WDV, written down value at the end of the year. So the example will explain it. The cost of the asset is 20,000 and the rate of depreciation is 10%. Okay. So in the first year what happens? 20,000 will be the cost and 10% depreciation means at the end of the year it will be 2,000 will be deducted. So that makes it 18,000. WDV at the end of first year is 18,000. Now 10% again will be charged on this at the end of the second year. So 1800. This will be depreciation for the second year. So now the WDV will be 16,200. Now in the next year, 10% on this 16,200 will be calculated. In this way, the depreciation keeps on getting calculated. Now the advantages are, this is a practical method. This is also accepted by the income tax department, and WDV method considers that asset will be more efficient in the earlier years. This is the main reason why the amount charged for depreciation is higher. So second is uniform effect on the profit and loss account. The asset requires less maintenance costs and repairs in the earlier years. So a higher rate of depreciation in the earlier years and the repair cost will be less. And as after a few years of usage, the repair cost starts to rise. So as the WDV method leads to higher depreciation in the earlier year, the expenses for both the repair and depreciation remains almost constant throughout the life of the asset. So official method, because this is recognized by the income tax authorities, and suitability, that is method is suitable for assets with longer lifespan that requires more repair as they get older. Now disadvantages will be, the asset cannot be completely written off. As in straight line method, the asset value comes to zero. But in WDV method, this will not happen. Second is that rate of depreciation cannot be determined appropriately. The third is that it results in lower net income during the initial years as the amount of depreciation is quite high. The last is the actual use of asset is not taken into account. Now the unit of production method. In this method, depreciation is calculated based on the actual usage or the output of the asset. So depreciation, the formula is cost of asset minus the salvage value divided by total estimated units of production. Now to sum up, let us read a few terms that is related to depreciation which are very common. First is cost of asset. This is the price which you pay when you purchase the asset. This includes the installation cost, the transportation cost, all the costs that are involved to make the asset usable. So even if the installation or transport or even freight, these type of costs, they will all add up to the cost of the asset. Then second is salvage value. The estimated amount that an asset is expected to be worth at the end of its useful value. That means the amount that you expect to receive from selling the asset after you have calculated all the depreciation at the end of its useful life. So this is the salvage value. The useful life is the period over which the asset is expected to be used fully, and book value is the value of the asset after accounting for depreciation. So with this we come to the end of this chapter, depreciation theory. So in a few more videos later on, I'll explain you with the help of examples, and it will be very clear to you. So thank you, students, and for more and more clarification and more explanation, please visit our website www.brightmindgurukul.com. Thank you.